And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal. The full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to the show. Of course, it is Tuesday, which means John Penn's here. So we'll be talking about Two Dads on Money today, talking about some topics relating to younger investors and what some of the traps and pitfalls that younger investors may be walking themselves into in this particular market. So we'll get into that today. Headline news this morning, and we'll talk about this a little bit more during the Before the Bell segment. But kind of the markets are pointing higher this morning. Not a lot, but a little bit, particularly on the S&P and the NASDAQ. Nvidia is now able to restart shipments of their H20 chip, spit that out, to China, just not 3 times fast. But yeah, so they're going to restart those shipments out. That stock's up about 5% this morning, so breaking out to new all-time highs there. That's kind of dragging up the entire tech index with it. And the reason, of course, it's one of the larger cap companies in the market, so with the biggest weighting, and so it's kind of dragging the whole market up with this morning. But AMD also following suit on expectations that they'll also be able to resume chip shipments to China. So again, that's kind of helping the semiconductor space, and again, this is kind of goes back to conversations we've had previously that there was all this angst. It was very interesting. In fact, today's daily market commentary talks about this very particular issue. So just before the Trump administration announced tariffs, CNBC ran this huge headline article that says, "Tariffs don't create revenue. It's just a tax on consumers." So yesterday, CNBC ran an article that says, government runs biggest budget surplus in 9 years due to tariffs, right? So again, all this stuff that expectations were. Tariffs were, that was going to be the demise of the semiconductor market, and AI is dead now because of tariffs, and we've heard all these stories. Yet none of that has actually come to fruition just yet. And now with this resumption of trade between Nvidia and China, that's certainly going to help kind of lift the markets here temporarily. But the big question this week, of course, is going to be CPI, the Consumer Price Index. We also have PPI this week, which is the producer side of the equation. And everybody's kind of eyes on this right now to see if there's going to be inflation from tariffs. This has been the big consternation from Jerome Powell and the Fed, saying, well, we haven't had inflation yet from tariffs, but it's coming. And yet we haven't seen it yet. And we've had 4 straight reports in a row where analyst estimates have been, or CPI came in weaker than analyst estimates. Right now, analysts are expecting, depending on who you talk to, anywhere between a 0.2 to 0.3% increase in CPI. So we'll see what that report looks like. And again, then we'll take a look at PPI as well. But remember, on CPI, 40% of that is housing. And housing is continuing to weaken. So while there may be some impact of tariffs in the CPI index, the overall index may indeed still be weak because of the impact of the very large components of housing and homeowners equivalent rent on that index. So again, we'll see what that report looks like. We'll talk about it. The one report to kind of really look to see if there are tariff impacts is going to be the producers, because producers are the only people that actually pay tariffs, and then they try to pass it on to consumers. So PPI will be really, if you're looking for a tariff impact, PPI this week will be the one to kind of pay attention to. And that's going to, those 2 reports obviously will kind of set the stage for the next Fed meeting, whether or not that they're going to be cutting rates. So again, we're going to have some action this week. And then also don't forget, we have bank earnings starting this week, JP Morgan, Bank of America, Wells Fargo, et cetera. The big major money center banks will kick off their earnings reports this week. And then next week, and the week after, we just get into just the slew of earnings. So earnings are about to dominate the markets here for the next 3 weeks. Buybacks also now at a record high, well on track to exceed $1 trillion this year. And despite the fact that we've had all this other stuff going on, corporate buybacks have absolutely surged here over the last few weeks, which is what's been one of the big drivers for the S&P. Has been that resumption of buybacks post the April tariffs, which was right at the end of the reporting period. So, again, as these things tend to occur, we'll keep a watch on it. But overall, markets are doing fine. In fact, let's just go ahead and talk about what you need to know before the bell this morning. So first of all, the market rallied just a little bit yesterday. Again, we kind of just flirting here with all-time highs and trying to just navigate this market here temporarily, which is fine. Again, markets are overbought on several levels, but again, nothing overall is kind of really concerning relative to the markets right now. But there are some things to kind of pay attention to, which is the market's always set up for rotation at some point, right? So the market itself is doing okay, but it's being driven by primarily three sectors. It's being driven by industrials, transportation, and technology. And those sectors have really been outperforming relative to the S&P here over the last few weeks in particular, but they are extremely overbought. Those sectors are extremely overbought now. In fact, if we just take a look at technology just as a good example, because it's been kind of leading the charge here as of late, just a fantastic move here recently in the technology index, despite all the concerns about tariffs and AI is dead and all this. Technology has really been kind of leading the way. And again, like I said, if you take a look at industrials, they've also been posting well, and particularly and this is kind of this whole idea of this AI infrastructure build out requirement. People kind of piling into that. Companies that are in that index in particular have been doing well. But again, these sectors are getting very, very overbought. So as is always the case, what happens at some point is you get a rotation from these leading sectors. You get a risk-off trade in the markets, and then that pulls money back into areas like staples, which have been underperforming really as of late. And again, despite the fact that you have the markets breaking out to new highs, staples have not, and they continue to kind of support. But this, those kind of company areas, staples, take a look at financials, which again, about to start reporting, they're doing okay, but they're kind of dragging relative to the market. So if we get into a risk-off trade in the markets, the point is that money doesn't necessarily leave the market, it just changes where it goes to. So if we get a risk-off trade for whatever reason, and look, there's a rising probability that we'll get some type of risk-off trade, 3 to 5% over the next couple of months. If that happens, we'll see that rotation into areas that have been really underperforming. REITs as a good example, but they're interest rate sensitive. So interest rates have been kind of moving up here lately. Not surprising, they had a big rally, so giving up some of that rally. But REITs have been kind of lagging here in the markets, but that could be a rotational trade to look at if we start to see, we see weak CPI is again, and a weak PPI number that increases the odds of rate cuts. That's going to bring interest rates down. And declining interest rates will bode well for real estate plays. So again, that kind of sets that market up for that rotation. Again, doesn't mean you make that trade today, but it's something you want to kind of keep a watch on, because we're getting a pretty big deviation between these kind of risk-on trades and the defensive risk-off trades. Same thing goes between high beta stocks, like if you own an ETF, like the S&P High Beta Index. Vanguard Value Index has been extremely out of favor. So you'll see a rotation potentially between high beta and value and kind of the ETFs as well. So again, just these are just kind of things to think about. I posted a couple of charts about this on my Twitter page this morning. So if you go to X, follow @Lance Roberts, I posted a couple of charts about this potential rotation trade on my account this morning. So again, but that's what you need to know before the bell this morning. We'll come back and we'll talk a little bit about money for millennials, so to speak, but really just if you're a younger investor in the markets, there's some things that are happening right now in particular that we've seen play out kind of over time that are potentially a big risk for you. So we'll talk about that when we come back with John Penn. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Got questions about retirement? Let's talk about it over coffee. Our next Candid Coffee event isn't another sales pitch. It's your chance to learn how to turn savings into strategy and risk into confidence. Richard Rosso and Jonathan McCarty share the RIA Retirement Blueprint Saturday, July 19th, in a special Candid Coffee edition designed to help you structure your savings, level your risk, and craft a secure future. If you fail to plan, you plan to fail. Register now for the RIA Retirement Blueprint, Saturday, July 19th at realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
What happens when you get an amateur driving the bus?
Hey, nothing wrong with a little just
It was
silence, a little downtime. It's okay.
It was a dramatic pause.
It was. Just to build a little suspense this morning. Make sure people are paying attention.
Morning, John. How are you?
Good morning. How are you?
Awesome. So, John and I wanted to spend a little bit of time this morning. We're seeing quite a few things that are going on, particularly with younger investors right now in the financial markets that, while right now they're not an issue, there are some things that are going on that will become an issue kind of sooner rather than later. And it's always the case. And this is where, again, when you talk to your kids, this is where they kind of roll their eyes in the back of their heads like, yeah, whatever, Dad, you just don't understand. Bitcoins, or Ripple, whatever it is, where the world's going to. And I get that, right? So, I own Bitcoin, I own Ripple, I own some of these other coins. I get the story, I get the analysis, I understand all that, but everything moves in cycles. And when you have very big runs in certain things, they are going to correct at some point. And a good example of this was just not too long ago, and it's always fascinates me, John, how fast that we forget things. But in 2020, of course, we had the pandemic, and then we were sending checks to households, and nobody could go out and speculate or go and gamble, whatever. So they all turned to the Robinhood app and started speculating on their phones. And of course, we had the whole meme stock run, GameStop and AMC and all these type of speculative investments. Then we did SPACs, and young investors were taking on a lot of leverage and, speculating in a lot of these more risky names, and they were making really good money at it. And there were several Wall Street Journal articles that were written in 2021 talking about how the retail investor had conquered Wall Street. And we kind of warned you back then. We said, hey, be careful of that because Wall Street always wins at the end of the day. You may think you have the tiger by the tail, but it turns out that you don't. And this is kind of the same thing that we're seeing once again. We're seeing a lot of the same type of mentality by young investors, kind of more of a cavalier attitude about their money and investing that tends to work out not so well. And again, we saw that happen. Those same articles that were being written about retail investors and millennials in particular that were gambling in the markets, there was a whole series of articles written in 2022 about how they had lost some, most, or all of their money. There was a really good article about this one kid that had made $2 million trading in stocks in 2020 and 2021, and was now in Las Vegas waiting tables to pay his rent. By the end of 2022. And remember, 2022 wasn't a big correction. The market was only down about 25% at its trough. It wasn't a massive thing, but we saw retail investors down 35 to 50% during that same decline. Why? Because they had taken on this kind of exorbitant level of risk. And so we're seeing a lot of that same kind of behavior right now in the markets. And I'm talking to a lot of younger people at the moment, and I'm getting a lot of emails, and they're like, you just don't get it, right? I get it, right? This market is very bullish right now. And so it's easy to make money. And when I see Facebook, ads is like, or Facebook comments like, this market's so easy, I just throw money in and I just make money with it. Those are always really kind of good warning signs that you're getting to a bit of a more speculative, cavalier attitude to markets.
Yeah, and there's a difference between speculating and investing.
Yes.
There's a key difference between those two approaches, right? And to your point, I think I see it too. There's a trend in that younger generation where, I'm just going to put all my money in cryptocurrency. I'm going to put it all in Bitcoin, whatever that might be. And look, not trying to talk bad about cryptocurrency or talk bad about Bitcoin, but you just have to understand how it behaves. And are you really investing in that, or is it more of a speculative asset? And I've already seen it, Lance, where just like adults, when you're out there talking with your neighbors, talking with your friends, you're already starting to compare what your returns are. I'm seeing that within the younger generation too.
Yep.
Right, where the youth, they are already comparing what their investment returns are, and we're all happy to talk about what's hitting, and hey, I doubled my money. Look how smart I am. Okay, you probably just got lucky, right? But so you're already kind of getting sucked into trying to compare your return to that of others, when you really need to be focusing on how can you really set yourself up for the long term. And it kind of opens my eyes a little bit, where if I am visiting with a younger investor and that their return expectation is, I should be able to make 30, 40, 50% per year. It kind of takes me back to the mentality of the .com craze that was in the late 90s, early 2000s.
Right. And because we had a lot of the same attitude.
Yes.
And let me be clear, we're not, John and I aren't saying you shouldn't speculate, right? There's just a right way to do it and a wrong way to do it. And so kind of wanted to spend a little bit of time this morning is just kind of talking through, okay, look, you are young, right? This is great. You are very young, which means you have a very long runway ahead of you. So unlike us old people, which we have very few grains of sand left in our hourglass, we can't afford to take on exceptional rates of risk because we can't afford the losses because we can't make it up. But you can as a younger investor. But what you want to try to avoid is taking, your money and losing the majority of it and then having to basically restart all over again. The restarting process is doable, but it eats up time. And the one factor, and when you're young, and look, when you're young and you're in your 20s or your 30s, you think you have an eternity ahead of you. And it may seem that way. But if you wind up eating up 5 years or so, just keep trying to getting back to even, you lose a bunch of money, you got to get back to even again. That eats up what time you have to reach your financial goals. And there's a lot of really bad advice out there. I was just talking about this yesterday. I just saw, just put $75 a week into an account and make 10% a year on it, and you'll have $1 million by the time you retire. It's terrible advice, right? Markets don't work that way. And we talked a little bit about that yesterday. But it's okay to speculate, but you have to have a process in your speculation. And so I kind of wanted to talk through that a little bit this morning, kind of go through some of the rules to at least think about, just consider, right, in your speculating process. So if you're betting on Bitcoin, you're betting on, stocks like Oklo or CCJ, or you're betting on some asset that's doing really well right now. Penny stocks are making up about 50% of the market volume at the moment. So a lot of people taking on a lot of risk buying, very low price stocks, expecting, because if I can get a stock to go from $1 to $2, I'll make 100% of my money, right? That's not a bad trade. But that's a lot of risk to that. So I want to kind of go through some rules this morning with you to at least consider, right? I know I'm old, but at least consider the rules, and which will hopefully make you a little bit better, more successful investor over time.
So, but great point there before we start getting into the rules. So you just said, well, I can just buy a stock that's trading at $1. It only has to go to $2. It only has to go from $1 to $2 for me to double my money. But yeah, so in our minds, the move from $1 to $2 doesn't sound like much, $1 to $2, but that is a 100% return.
Right.
Right.
And $1 to $0 is also 100% loss.
Exactly.
It's the same dollar move.
That is exactly. It's called the math of loss. And so for our folks for us that are a little bit more seasoned, my kids call me old. I say I'm just a little bit more seasoned. To the younger generation out there, I cannot tell you how many folks I visit with today that are my age or actually older, and now they're getting closer to that period of time where they're needing to use these dollars that they've saved. That the topic around having to restart. Mm-hmm. Because if you weren't careful, if you took on too much risk with your portfolio in the late 90s, early 2000s, and then the market's pulled down pretty dramatically, and you sold out at the bottom, you're having to restart. That's restart number one. Then maybe you did that during the great financial crisis.
Restart number two.
Restart number two. Well, I've had a number of folks that I visited with lately where restart number three was, hey, I just couldn't take the market movement when the government was going into shutdown mode in Q1 of 2020, and I sold out at the absolute wrong period of time. I've had to restart my portfolio and my strategy 3 different times. As an advisor, as a fiduciary, our role is to help educate you so you can avoid making those emotional mistakes so you don't have to start over time and time again. Right.
And again, that's the key point. And we talked a little bit about this last week, is, these drawdowns occur. And they occur, but they're distant between those drawdowns. So 2000, then 2008, then 2020, and so there's a big gap in time in between that these drawdowns don't occur. So we get complacent because markets are just going up here. It's like, oh yeah, that was a one-time event, that occurred. And for a lot of younger investors, today that are in their 20s. So so this is where it kind of gets hard for me, right? Because when you start talking to somebody in their 20s or even in their early 30s, they didn't start investing, until 2009, 2010. So you've never actually been through, other than the pandemic, which was very short-lived and was just met with massive flood of stimulus. A lot of younger investors have never seen an actual bear market and have never been through it. So you don't really understand what that pain of loss feels like yet. But these things do occur, but they're fairly far apart. And we're starting to get the distance now between the financial crisis and where we are today, that markets are now have a lot of the same similarities to what led to previous big market downturns. And I'm not saying that occurs today, tomorrow, next week. I'm not talking about a crash. But you do have to recognize that this event will happen at some point in your life. And so when we come back from the show, from the break, we'll talk a little bit about investing rules to speculate with. So if you want to speculate, it's fine, but at least have some grounding in how to speculate properly. And I'm gonna kind of give you a strategy to help build long-term wealth while you're still speculating with your money. So we'll talk about that with John Penn when we come back from the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Got questions about retirement? Let's talk about it over coffee. Our next Candid Coffee event isn't another sales pitch. It's your chance to learn how to turn savings into strategy and risk into confidence. Richard Rosso and Jonathan McCarty share the RIA Retirement Blueprint Saturday, July 19th, in a special Candid Coffee edition designed to help you structure your savings, level your risk, and craft a secure future. If you fail to plan, you plan to fail. Register now for the RIA Retirement Blueprint, Saturday, July 19th at realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Last night I got home and my wife was all excited. I went to ChatGPT and I've laid out a whole business plan for a coffee shop. I'm like, oh God.
The Real Investment Show podcast.
Well, long time she's wanted to have her own bakery and I've been slowly encouraging her not to.
Same show, your schedule.
So I may be in the coffee shop business here soon, so I may need your help to support my wife.
The Real Investment Coffee Shop.
Exactly.
I like it. It's got a nice ring to it.
Sound of that.
Exactly.
We'll have a couple soapboxes in the corner. We can stand up and we can put them to sleep with economics. Then they need more coffee, and then we'll go through. We'll sell so
Brilliant.
much.
At realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show this morning. In exchange for me giving you the strategy for speculating and building long-term wealth at the same time, I need two favors from you. First, like and subscribe to the channel this morning. It certainly helps us very much. We've got about 65 likes right now and 500 of you in the chat room. So just reach over there and click that little like button for me. I do appreciate it very much. Secondly, Richard Rosso has a Candid Coffee coming up here this Saturday. It's going to be talking about retirement blueprint. But look, I need a favor here because like when I did my podcast with Danny Ratliff, we had like 600 people sign up for it. So Richard's all jealous. So if you would just sign up for the Candid Coffee this Saturday, I would appreciate that also. It will make him feel better. His little feelings get hurt and it's just a drag. So we need to help him out a bit. So sign up for that. It's on the website, realinvestmentadvice.com.
It'll be good. It'll be well worth your time. A lot of great stuff covered in there. It'll be good. See, I'm feeling you, Rich. I'm right here for you. It's going to be good. Mr. McCarty, he's going to be on there with him. It's going to be good stuff.
Yeah, well, at least there's one smart guy on there.
Wow.
So. Just joking. Just joking. Anyway, I just have to get him back for all the times that he makes fun of me while he's doing the show on Friday. He thinks that I don't listen, but I listen to the show on Friday while I'm getting the newsletter put together.
It's all in love.
It is. It's all in fun.
It's healthy.
Anyway, so speculating, the right way to do it. So the first, look, there's a lot of people that speculate markets that are successful, but I will tell you this, that people that solely speculate, and there is a very small handful of people that I have met in my life that are successful speculators, and they have a very strategic way that they speculate in markets. The vast majority of people that I've met in my life that speculate wind up losing most or all of their money repeatedly. They can make it about 2 or 3 years and they wind up blowing up. The difference always comes down to their process. And the best speculators I've met have a very basic process with how they approach their speculation. And first of all, they don't speculate with all of their money. So they generally have 2 pots of money. They have their long-term wealth growth strategy, which is just getting basically market-based returns, and it's a bucket of money that is always there that they add to from their speculating activities. Again, now this doesn't mean everybody does it this way. I'm just telling you this is my experience over 40 years of doing this in the markets, and I've met literally thousands and thousands and thousands of people that have done this, good and bad. So I'm just relaying to you. I'm not preaching to you. I'm just telling you what I've learned over a very long history of actually working in markets. And this is the one thing that is important, particularly if you're younger and if you're listening to the show right now or you're listening to other podcasts. Are people that are telling you things to do in the markets, are they experienced traders? Do they have a long history of this? Do they have this capability? Because I see a lot of YouTube people out there that are talking about, oh, this is happening, and they don't manage money. So they really don't. It's easy to talk about, oh, the market's going to crash or this is going to happen. It's really easy to say that kind of stuff when A, nobody holds you accountable, and B, you don't have any skin in the game. So make sure at least that you are listening to somebody that has experience in the market actually managing risk, whether it's me or not. I don't, that's not relevant. But again, when I talk to speculators, they have these 2 buckets of money. The speculation bucket feeds the long-term growth strategy bucket. So if I have, and we'll pick a number. Let's say you've got $20,000 to invest, right? You've got $20,000 to work with. And again, it becomes more difficult to speculate well with a very small amount of money. But hey, we all got to start somewhere, right? So take $10,000 and just buy an S&P index fund. And again, this I'm using 20,000 because it's easy math. This early in the morning, I'm only a half a cup of coffee in, right? So, pick any number. It doesn't matter. Wherever you're starting is fine. Just take half of it and buy an S&P index fund and leave it alone. Don't touch it. Don't pay attention to it. Again, you have a long time horizon in front of you that I don't have. So you can weather the ups and downs in the markets over time and let that S&P index fund grow with the rate of the market over time. You don't need a bunch of different ETFs. You don't need international emerging markets and this and that and the other thing. Just buy an S&P index fund. That's all you need. The other half of your money you can now speculate with. But you have to approach that speculation with a set of at least boundaries of what you're going to do. So again, if you look at some of the great traders throughout history, whether it's a great book to read is Michael Koval's Turtle Trading. If you'll just read that book, you will do better at your speculation if you'll just read that book. Get it in an audiobook form if you don't want to actually read the book, just listen to it. But he covers a lot, particularly very early in the book. You don't have to read too far into the book, but very early in the book, he talks about position sizing, risk management, these type of things. And it's a very good setup for your speculation. So if I have, again, so I'm back to 10,000 now. I've got 10,000 in the S&P index fund. It's just doing what the market's doing. Don't have to worry about it. Don't have to look at it. Don't have to care about it. I've got $10,000 set away somewhere that's going to grow over time. That other 10,000, I want to break it down into buckets. And I want to break that down into my high risk bucket and my low risk bucket. And I'm still speculating, but even speculation has high and low risk. So if I'm betting on, again, John and I were talking about earlier about, penny sub $5 stocks. They have no institutional ownership, right? So that's a high risk speculative bucket because you are really working at the whims of a very small group of people, low volume, et cetera. Those type of investments, so let's take $5,000. I shouldn't have more than $1,000 in any one of those type of investments. So we're going to break our $10,000 into two buckets, high risk and low risk speculation. I don't want more than basically $1,000, and I would probably even make it down smaller than that, no more than $500 in each one of those type of investments. Because if one goes wrong, $500 is 5% of your portfolio. That's going to sting if you lose that. So again, manage that risk, saying, okay, how much am I willing to risk? And and the way to approach this is say, if I lose that money, if it goes to zero, am I okay? And if you're doing $500 in a highly risky investment and it goes to zero, it's not going to kill you. When you get to $1,000, that's 10% of your portfolio, that's going to start to hurt. But you shouldn't have 25 or 50% of your money. If you lose half your portfolio all in one swing, that hurts, right? So manage that high risk bucket. Be much more conservative with that high risk bucket. Now, we're still speculating, but in what we call a low risk bucket of speculation are stocks like Nvidia that have fundamentals. They're big market driven companies. They're a major component of the S&P index, so they get fed by passive index flows. That's a lower risk bet. And I can still bet on that, and I can still take a risk on that, but I can allow more flexibility with that investment because it's a lower risk. So I can put $1,000 of my money into Nvidia as an example, and it can move up and down. But Nvidia going to zero is not a high probability, right? Can Nvidia drop 20 or 30%? Yes. But it's probably not going to go to zero. Sub $5 stocks have a really nasty habit of going towards zero. They're below $5 for a reason, and so that's why that's a high risk bucket. So again, break your bucket up into high risk and low risk, and then weight your holdings within that bucket in a manner that you can weather the volatility. John, comments?
Well, so a lot, great points. So, and again, these are dollars here that are above and beyond what you've saved for your emergency fund. If you're paying rent, you need money to replace, tires on your vehicle, what have you. These are not the dollars that we're talking about. This is money that is more for growth for the future, right? So S&P 500 index. I was just talking about this with our oldest daughter. She'll be 25 in October. A little bit earlier this year in April, when markets are pulling down more significantly, she gives me a call. Dad, markets are pulling down. What should I do? I said, buy more.
Yeah.
What do you mean? Everybody in here, everybody in my office is freaking out. I said, kiddo, Audrey, stocks are on sale. Buy more. Don't let these market narratives derail you, right? And then with the more speculative side of the portfolio that Lance was talking about, like one of the examples, one of the names of the businesses that he provided was Nvidia, whatever it might be. These are just some names, not recommendations that I'm putting out there.
Yeah.
Nvidia, Microsoft, advanced micro devices, whatever it might be. Before you buy those shares, do some time and research the business. Before you buy it, make sure you understand what does the company do and why do you own it.
Right. Absolutely. So when we come back from the break, we'll kind of wrap this up. But I want to talk a little bit about time.
Yeah.
Time in markets and timing the market just a bit, because again, when you're young, you have this massive asset of time that is more valuable than your money. And we'll talk about why you need to manage that just as much as you need to manage your portfolio. So don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Got questions about retirement? Let's talk about it over coffee. Our next Candid Coffee event isn't another sales pitch. It's your chance to learn how to turn savings into strategy and risk into confidence. Richard Rosso and Jonathan McCarty share the RIA Retirement Blueprint Saturday, July 19th, in a special Candid Coffee edition designed to help you structure your savings, level your risk, and craft a secure future. If you fail to plan, you plan to fail. Register now for the RIA Retirement Blueprint, Saturday, July 19th at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show this morning. So just kind of, want to kind of bring this to a final point. And again, speculating in the markets when you're young is completely fine. The important thing that we have to consider is we have one asset that we can't squander, which is our time that we have available to us to invest. And the sooner you get better, the younger you are. And again, there are some, and John was absolutely right. Before you even start investing, build an emergency fund. And an emergency fund is 6 months worth of your living expenses. And I know a lot of people say, "Oh my gosh, why are we talking about this?"
Thanks, John.
Oh, but it's important, because again, when markets go down, and they will, and like John was saying earlier, this is a great point. So in April, markets are down 20% from their peak. That was we wrote that article called The Hope and the Fear. That was a great opportunity to put capital to work. But if you haven't got any other capital to put to work, you can't buy that dip in the markets. So what an emergency fund gives you is two big benefits. And this is why you need to have one. If you're going to speculate in the markets, you need to have an emergency fund first. And maybe emergency fund isn't the right word, and when used in this manner. So normally the reason we call it an emergency fund is if the refrigerator breaks down, car breaks down, you don't want to have to go sell all your assets to go fix the car. So that's why it's called an emergency fund. But there's also this pool of savings that are sitting there that are opportunistic as well. And you just have to remember, you have to replace whatever you take out of the emergency fund.
Maybe we call it an opportunity fund.
Maybe it's an opportunity fund. Because if I have that pool of capital there, when markets do draw down, I've got to have something there to invest. So that gives me a pool of capital that I can invest when markets dip and help build my portfolio. It also helps repair. If I take losses on certain things and the markets are declining, I can rebuild my balances so I can start compounding from lower levels in the markets. So an emergency fund, really important to have, because again, if something does happen and life happens, right? There's going to be something that goes on, your car breaks down, something happens, and it's going to cost you $1,500. You don't want to have to go sell your assets, because generally, just Murphy's Law says is that when that happens, it's the worst time to sell in the market. So you don't want to be forced to sell. So you want that kind of pool of capital sitting there.
That's right. Or what if you're in between job opportunities, or you lose your job for a while? You know, it's nice to have a pool of funds that you can draw from where you don't have to start racking up a bunch of debt, right?
Right.
And to Lance's point, it usually never fails when the investments, publicly traded investments, are very liquid. They typically settle within one business day. That means if you sell your asset, sell that investment today. We mentioned Nvidia earlier, Microsoft as an example, Bitcoin, whatever that might be. You can sell the investment today. You've got the cash in hand tomorrow. It's typically a one business day turnaround, so they're very liquid. But the issue is you just don't want to be selling those to raise cash to pay your bills at a time where maybe markets are pulling down by who knows what, right? You just don't want to put yourself in that position.
Well, and also too, if you're being forced into selling your assets to pay bills, now you don't have any money to invest with. Right. So now you've impaired. And again, this all goes back to the time factor. If I'm forced to sell my assets because I don't have an emergency fund sitting there, and I'm out of the markets for 6 months or a year trying to rebuild my, trying to get back on my feet, get money invested again, that I just burn a year of my growth time. And this is the big fallacy when people come along, and this just burns me up to no end. I just want to I stomp around the house, and I'm just like, drives me crazy. But like I heard this girl on TikTok, and she's like, $75 a week into an IRA, to an investment account, 10% a year. We just went through, a 25% drawdown year or 20% drawdown year in 2022. Markets don't compound at 10, right? And those drawdowns impair your growth returns over time. And so it's always amazing when you start mapping this out. It's like, if I can just make 10% a year or 20% a year, I'll be a millionaire by the time I'm 30. Factor in what happens if you lose 10 or 20 or 30% in a year, because it's going to happen.
Yeah.
Right? That's just markets. But if you lose a bunch of money and can't get yourself restarted again fairly quickly, that just eats away at that time you have to build wealth. And time is that one commodity we can always make more money. We can always make better investments. We can always make better choices. We can't make more time. Right? So that's the one thing we have to really be most conscious about.
Yeah, I routinely say if I'm ever at a get together, gathering friends, what have you, or meeting some new people, and they ask me, "Hey, John, what do you do?" My response is, I try to give the people I serve back their most precious asset. Mm-hmm. And folks will say, "Well, what is that?" I'll say, "It's their time." Well, how do you do that? And then we talk a little bit about kind of our roles as fiduciaries and what we do. But you're so right. So when you're late teens, early 20s, you've got part-time work, whatever that might be, your first post-career job where you're out there earning income, just start. Just start putting money aside, right? Even if it's in your employer-sponsored 401k plan, or if it's a 403b, and look if it's what are your choices? Can you contribute pre-tax? You can contribute pre-tax. Sorry, dumb comment. You can contribute pre-tax. What I meant to say is, can you contribute after tax? Can you contribute Roth? Right? And what's the difference between the two? I mean, that's a whole segment that we could talk about there.
Yeah.
But a lot of times, Lance, when I'm visiting with folks who are, as I like to say, more seasoned, a little bit older, when you look at all those different pots of money that they have, kind of their speculative assets, then they've got their money in their company retirement plans. Most of the time, I'd probably say about 80 to 85% of the time, of those various buckets, the biggest pot of dollars is that employer-sponsored plan, because they set that up at a very early age, and it's automatic. That money just goes. That it's an automatic savings every paycheck, every pay period. Just start that behavior, because as soon as you start it, then you don't see it. The money it just happens automatically. No matter if the markets are up or down, you're buying shares.
Yep. And again, that's the out of all the clients that we have.
Yeah.
Right. I would venture to guess that we have less than 2, maybe less, that have all their money basically just from speculating markets.
Oh, completely agree.
Yeah,
completely.
The vast and this tells you this is the record, and we manage money for thousands of people, right? So And this just tells you the case about the difference between what you hear on television and in the media and on YouTube channels and all that versus what happens in reality. And to John's point, the vast majority of our clients, the bulk of their wealth, unless they sold a business, is in their 401k plan. And when they come over, they're like, I'm ready to retire. Here's my 401k plan. And I have some money over here in this other investment account, but it's generally never as much as what you see in their 401k plan. And that just tells you that what happens most of the time is that the personal trading that you're doing on your own underperforms that kind of buy and hold strategy inside of that 401k plan over long periods of time because of emotional biases, because of risk taking, because of all those type of things. You tend to perform worse than than just investing in a pool of assets and let them grow.
Yeah, it's very common for folks that have been saving in their retirement plans for decades. Really, I mean, we're talking about time here. Like Lance's point, we're talking about time. This isn't something where you put your money into a retirement plan or an investment strategy, and then within 24 hours, 48 hours a week, all of a sudden you've doubled or tripled your money.
Yep.
It doesn't. That's not real. Yep. Right. It may happen. You may invest in something and you hit a home run right out of the gate, but really the goal is over time. If I could relate this to baseball, I had my baseball cap on last week.
Yeah.
You want to hit singles and doubles over time. Be consistent. Just get on base.
Yep.
Right.
And you really will be more successful. But again, if you're young, hey, we get it. My kids, they're fascinated with the stock market. They want to buy, whatever they read about on TikTok or whatever. And they call me up and say, hey, I want to buy this. And I'm like, that's fine. But just understand this, right? And again, this goes back to these basic, just have a strategy, and how you design your own strategy, your own discipline is up to you. But that's the key. Successful investors over time, the ones that survive the long term, are ones that have a very defined, disciplined process, and they adhere to it. Position sizes. It doesn't matter what asset you want to buy. You want to buy Bitcoin, Ripple, whatever. You want to buy, speculative stocks, gold. It doesn't matter what the asset class is. If you have a defined, disciplined process for taking profits, cutting losers, rebalancing risk, doing that type of stuff on a regular basis, then you're going to see it. I've got an investment guide coming out. In fact, it should be out today or tomorrow. It's about 24 pages. It's an ebook with all the investment rules in it. So as soon as we get that posted, I'll give you the link to it so you can give it to your kids, or you can read it yourself, download it yourself. It's free. But we're putting all these kind of guideposts about psychological biases, etc., into a book form so you can have it along with trading rules so that you can trade better with your own money. And again, it's just about managing risk over time, and you'll do well. But again, this is, as always, the problem with a parent talking to a child, me talking to my kids, they're like, yeah, whatever, you don't understand what's going on in the world today. I do. I've seen this. John's seen this. This story plays out over and over and over again. This time is never different. But if you have a guide to work through this, right, you can succeed and be very wealthy at doing this. You can build wealth in the markets if you treat the market properly. If you treat it like a casino, it's going to treat you like a casino, and it's going to take all your money from you. But if you treat it right, the markets can make you very wealthy. All right. Hope that helps. And John, appreciate your time today.
You bet.
We got lots of stuff to cover on Two Dads on Money coming up. Credit cards, investing long-term, insurance, buying a house for the first time. We got lots of topics coming up over the next few weeks, so we'll be getting with you on those. Get by the website, realinvestmentadvice.com, and be sure to like and subscribe to the channel. We appreciate it very much, and we'll see you back here tomorrow with Danny Ratliff.